Today. My name's Rhett Rankin. I'm one of the co-hosts with Mark Priska for today's webinar. And Mark and I are brokers with the Dimond Bros Insurance Agency. Just a few housekeeping rules before we get started. The webinar is being recorded, and please direct all questions through the chat. We'll have a question and answer session at the end. Share my screen here real quick. Okay, so just a quick couple slides here. Today we're partnering with the Ryan Specialty Benefits to provide a modern approach to providing affordable healthcare. A little about Dimond Brothers, our history. We were founded in 1867 as an independent insurance agency. We're top 100 privately held insurance agency with over 300 employees and 50 offices, serving local, regional, national, and international accounts, over 65,000 accounts through all offices. Our value proposition today is to talk about the current state of healthcare. We're all experiencing rising healthcare costs with no control to maintain reasonable inflationary increases. Our expend has increased 2-3 times in the past couple of years with no relief in sight. With little to no reporting or transparency, most districts are unable to address the high cost drivers of the medical plan. And today, Ryan Specialty Benefits will present solutions that provide better strategies, take back control, and provide competitive pricing. School districts across the country continue to face increasing pressure from rising healthcare costs. Often the increases are caused by specialty medications, popular medications like GLP-1s. Prescription drug expenses are the fastest growing driver of overall medical spend, and with over 330 new specialty drugs in development, this epidemic is not going away soon. These challenges impact district budgets and cause real concern to afford employee health care for the foreseeable future. So with that, I'm going to turn it over to Mark. I think you got some additional words to share with us.
Good morning, everybody. So today we will discuss practical strategies that can help districts take greater control of these costs while improving transparency and accountability. We'll focus on key areas such as cost containment initiatives, specialty prescription manufacturer assistance programs, and care navigation strategies that help members access high-quality, cost-effective care. By combining these approaches with robust reporting and actionable analytics, districts gain a clearer understanding of where healthcare dollars are being spent and where opportunities for savings exist. This level of transparency enables informed decision-making and more effective management of healthcare trends over time. Let me ask you a rhetorical question. How many of you have experienced a high-cost claimant or known of an employee that's taking an expensive 6-figure-a-year medication and felt handcuffed by the cost? You were likely feeling helpless. Our goal today is to show how a proactive, data-driven approach can help mitigate escalating healthcare expenses and create a realistic opportunity to stabilize or even level medical spend, all while continuing to support employees' access to quality care. We are excited to share these strategies and discuss how they can be tailored to meet the unique needs of your district. And with that, I will turn it over to the fine folks at Ryan Specialty.
Well, thank you very much. So my name is Peter McDowell, and I'm with Ryan Specialty Benefits. I'm going to take you through a few slides just to tell you about who we are and some of the services that we provide. And then I'm going to turn it over to, I have two colleagues on the line today. We have Laura Garcia, and she'll introduce herself when it's her turn to speak. But she's an expert in the pharmacy field. And my other colleague is John Clark, who will take you through one of the funding solutions that we offer at Ryan Specialty Benefits. So with that, I will share my screen. And please give me a head nod, Mark, if you see my screen. Okay. And before I start, I do want to thank Mark and Rhett for inviting us today. We hope that the information that we provide today will be of interest to you and will result in some meaningful conversations with Mark and Rhett and the folks at Dimond Brothers. So Ryan Specialty Benefits, let me just get there. So we are, Ryan Specialty is a Chicago-based company. We are made up of 5 different companies within Ryan Specialty, one of which, of course, is Ryan Specialty Benefits. Ryan Specialty, as a whole, is a global company. It's been in existence for about 16 years. It's a publicly traded company. If you're familiar with Aon, the gentleman who started Aon, Pat Ryan, started Ryan Specialty, and he really found that there's a need for the specialty benefits market, and so we were born. But we have 129 offices, roughly 6,100 employees throughout those offices, and we've done that through the work of acquisitions and building companies from the ground up. So this is an idea of who we are. So Ryan Specialty Benefits is made up of about 200 employees, and we run the gamut. So our job is to work with brokers, like the folks at Dimond Brothers, to provide solutions for their clients. And we do so by tapping into a vast array of expertise. And those expertise are everything from providing a proposal to the digging into the data analytics. We have actuaries on staff. We also have a team of over 30 underwriters on staff, which is very helpful. We have, as I mentioned, the pharmacy consultant group, which Laura is our lead. We deal with complex claims and clinical, as well as ancillary benefits. And so these solutions are all available to the folks at Dimond Brothers. So we provide all of these services, and that way they're able to bring you the best solutions available in the marketplace. We've also spent a lot of time and a lot of money investing into technology, and that comes in the form of AI, which we've all heard a lot about, and some of our updated underwriting platforms, healthcare insight tools, clinical applications, as well as data analytics. One of the services that our broker partners really love is what we call the 48-hour risk assessment. And essentially what this is a tool for you to see how your group looks. We take your information, and that's just really a census, and we run it through a series of platforms to gather as much data about claims and pharmacy and medical spend for the last 12 months. And once we take that information, then of course we have humans that also look at the information, and we go through a process of analyzing the information, and we provide a deliverable. And this deliverable is very valuable because you're able to see what are the drivers. Now, we don't have full insight into all of the claims and everything that's happening at your school. However, this gives you more than you probably have already because of our technology. So when we have the deliverable, it looks like this. So we have a rating scale, and a 1 being fantastic. And we tend to call those unicorns because there's not a ton of them out there, right? We all have people with healthcare needs, and that's what insurance is for. So that's a good thing. But typically we're dealing with groups that fall into the 2, 3, and 4 range. And so a 2 and a 3 are going to be really good risk prospects for us. They're still probably going to have their own challenges. 4s and 5s have stronger challenges. So the result here is, and this is just an example, ABC Corp. It got a 2. That's a great score. So we provide positive observations in this top box where my cursor is. And then we also identify the more challenging aspects of, oops, my fault. I went one too far. So this box contains the more challenging aspects and characteristics of the group. And then as you move to this right-hand side, we're going to give some case statistics. How many people are in the group? What's the average age? Things of that nature. We also look at risk stats. We have to have a level of match rate as we go through our technology process. And so we have to have at least 80% match rate. In this case, we have a 94% match rate. That's very good. So we also talk about high-risk members, relative risk, demographic risk, right, based on those variables, and morbidity risk. And these last three, if 100% is average, anything below 100% is a favorable risk. But we also identify in the top right-hand corner high-cost medical things that are happening to the group over the last 12 months or so. We also identify those high-cost pharmacy spend that the group is going through. At the end of that process, we talk with the broker, speak with the broker about what's the right funding mechanism, what's the right solution for this group. Many people are fully insured and they're looking for opportunities to leave the fully insured world. And John will talk more on that in a bit. So that's an overview of who we are and one of the services that we provide as a great service to our brokers and ultimately their clients. So now I'm going to hand it over to Laura, who can tell you a little bit about herself and jump into the world of pharmacy.
Sure. So first we'll talk about clinical advisory, but my name's Laura. That's okay. My name's Laura Garcia. I'm the director of pharmacy here at Ryan Specialty. I actually work very closely with my colleague, Karen Quinn-Rayfuse, who is our director of clinical risk management. She is out today, so I'm kind of stepping in to talk about clinical advisory for her. But as Peter was talking about the last slide, those two boxes to the right, the top medical and the top pharmacy, we are really the next step in that risk process. So once that 48-hour risk assessment is done, if there's anything that's identified in those two boxes as being a high impact, or if it's a 4 or a 5 that needs some work, typically that'll come to our team for requests for any types of interventions that are available. So for the clinical advisory team, that has a lot to do with, when dialysis is, identified, or there are J-code issues, and the drug is costing, the plan $200,000-$300,000. Any of those large bill reviews, transplant contracting, anything on the medical side that is going to be looked at as being either a potential emerging risk or as a laser from a stop loss perspective, our team will intervene to look at that. What we want to provide to Dimond Brothers is the opportunity to get in front of some of those emerging risks that have been identified and offer solutions. So if you're in a fully insured environment, typically you're kind of handcuffed into whatever is available within that ecosystem. And so what we'll try to do is bring forward things either that we know work within that ecosystem that can help mitigate some of the cost, or we can make a recommendation outside of the ecosystem that we have seen, be valuable to other clients. So we have a lot of we have a lot of people here who have worked in other industries and have other expertise that have seen things work outside of like a fully insured environment. And so we tap into those resources frequently. Peter, you can go to the next slide. There we go. So from a pharmacy perspective, so think about the boxes. So the second box is pharmacy. And that's where we identify a lot of those high cost specialty medications that are being filled on the pharmacy side. So remember, there are some drugs that are still filled through medical that, and there are some that are filled in pharmacy. One thing that I want to touch on here, as we're talking about pharmacy, is that there are some medications that straddle both. So, for example, your J codes, some of those J code pharmacy that's filled on the medical side could actually be sourced on the pharmacy side. And so what we try to do is when we see that occurring, we will bring that to the attention of Dimond Brothers to say, it's worth having a conversation with both parties to see if that sourcing can happen on the pharmacy side. Typically, the cost there is a lot cheaper. So again, the J codes, and I have somebody asking what a J code is. So a J code are those infusions that are happening in the medical environment, either at a doctor's office or at an infusion center. Those particular types of medications, some of those can be filled on the pharmacy side. So thank you for that question. And so what we want to do is always bring forward what are those solutions that can work. We will also look at recommending even moving your pharmacy to a transparent pass-through PBM. We are big fans of the transparent pass-through model because it creates that opportunity for you to get data, to be able to see exactly what's happening, and to put in mitigation strategies that either are within the PBM or are outside the PBM. Currently, if you're in a BUCA, they typically frown upon doing things like alternate funding, international sourcing, any kind of medical infusion oversight. And so what we can do is recommend, PBMs that we have seen that do a really good job of, providing mitigation strategies for high cost medications, provide, rebates back on a monthly basis, really whatever solution that the client needs to meet their needs. Again, the goal is to create that transparency for you so that you can actually see what's coming and we can help mitigate and provide some of those strategies. So I'll stop there. I think John and Peter know I can talk about pharmacy all day. But definitely for the Dimond Brothers, we're here for you as well as for you as the clients to answer any questions, ask for any assistance, and really give you any kind of cost mitigation strategies. Again, that can either work within your current ecosystem or outside of that ecosystem.
Laura, real quickly, because I know that
Sure.
that Mark and Rhett touched on it earlier. Do you want to spend just a minute talking about GLP-1s and how it's affecting the industry as a whole, and all the way down to individual plan designs?
Sure. So GLP-1s, should we cover them? Should we not cover them? That seems to be the big question today. What I want to do is differentiate between the GLP-1s. So you have GLP-1s that are prescribed for things like diabetes, sleep apnea, and then you have the GLP-1s for weight loss. So I really think that as you go into your strategy for 2027, you should be thinking about whether or not you're covering it for weight loss. So to give you some perspective, I did pull a couple of numbers. Back in 2022, GLP-1s accounted for about $4 PMPM across the board for all weight loss and medical diagnosis. In 2025, without covering it for weight loss, you're looking at $10 to $15 PMPM. If you include weight loss, you're now impacting the plan $27 PMPM. So you really have to weigh that. So do you want to cover it for weight loss or not cover it for weight loss? If you decide to cover it for weight loss, you should really consider having some strategy in place to allow reauthorization, make sure that the members are being followed, throughout. Are they, doing the steps that they should be including with their GLP-1 journey? Like, are they working out? So it's programs that are really designed and tailored to work in conjunction with the GLP-1, not just taking the GLP-1. So those strategies seem to be the most robust and also have proven to show more success, right? The goal is not to be on the GLP-1 in perpetuity. The goal is to use it to kickstart your journey, and then to eventually taper off. So you really do have to have a weight loss program included if you're going to cover the GLP-1s. And like I said, that's something that we have seen kind of, take an uptick. Also, as you see other GLP-1s coming into the market, we just had the pill form come out, Foundeo, which is it's the Zepbound pill. There's also going to be what they call a triple G or a 3 agonist called retatrutide that will go into third phase trials at the end of this year, which is basically that next gen of the GLP-1 GIP category. So again, you need to have robust PAs, edits on these drugs so that, when someone wants to get on a drug, they start kind of in that foundation level versus starting at the very top and getting like that next gen as the first line of therapy. So I think a lot of the PBMs are doing a really good job of trying to tailor their and PA edits in that. But again, those still need work, and you still have to ask the question, what are qualified? And we can help look at that with you and ensure that, the things that are being prescribed are, obviously for the right reasons, for the right individuals, and that they're meeting those qualifications.
Yeah, thank you, Laura. Those are great points, because with the predominance of these advertisements, right? It's everyone is seeing these, they're aware of these, they're asking their doctor about it. They may even be asking the HR at your school, is this covered? And to your point, the nuance of understanding how it's covered is super important. And so thank you for pointing that out.
Absolutely. I do want to, Peter, I'll touch on one more thing that, because it's something that's emerging in the market, is the biosimilars. So we've seen the push for the Humira biosimilars. What we have started to see happen is less push towards the biosimilars and more push towards other high cost medications in that category. So, and this is in the anti-inflammatory category. So think of drugs that treat the same things as Humira. So it's really important to have a biosimilar strategy, because you really want members starting on those biosimilars first before graduating into those other high cost medications. And so, I challenge you, especially being in a fully insured environment, you're going to get a report for your renewal. There's going to be 2 pages on there that talk about pharmacy. And I challenge you to look at those high cost medications, because what you're going to see is maybe 2 years ago you had Humira, but now you're going to see Tremfya, Cosentyx, Rinvoq, Skyrizi. And so you really need to have that biosimilar strategy to start with the biosimilar. And then, if you need to graduate into those higher cost medications, graduate there. But we have been seeing that shift away from Humira into the higher cost medications. And there are mitigation strategies for those. If a member's already on a Skyrizi, you can consider international sourcing or sourcing from another vendor. But those are all things that we can get into detail on a plan specific basis.
That's awesome. Thank you, Laura. So again, her expertise is at the disposal of the Dimond Brothers group. So know that. So next, I'm going to turn it over to John Clark.
Hey, Peter, stay on that slide just for a second,
okay,
if you can.
Yes, sir.
And I've gone off camera because my internet connection's a little wonky. So if you don't hear me, let me know, and then we'll transition to Peter. But again, thanks for joining us today, John Clark with Ryan Specialty Benefits. In the reason I wanted to pause on Laura, one, I'm so impressed that she has the ability to pronounce all those drugs, because I think that in itself is amazing. But here's the difference. As you sit there and you think about being, again, we use the term fully insured, which means you pay a monthly premium. And I'm going to assume, and maybe that's a bad assumption, that everybody on this call is currently fully insured. And Laura used the term BUCA. So that's your Blue Cross, your United Healthcare, your Cigna, your Aetna. So you're fully insured with any of those traditional carriers. And so that means that you pay them, that insurance carrier, monthly premium, and you never know what they're doing with that premium. They're paying claims, they're paying their administration costs, and then maybe once a year you get a renewal with some claims experience information, and you go, and here's my rate increase. And you go, wow, that's a big increase, because it's always going to be a big increase, and you have very little control. So what we're going to talk, what Laura talked about is strategies and control. Because if you consider leaving a fully insured, you will need to implement, and that's where the effort of Ryan's Specialty and the Dimond Brothers will assist in a strategy to control your claim spend. So again, my guess is your healthcare costs is the second highest cost sheet on your ledger next to your payroll and salary. So we're looking at something that is a big spend today, and it's only going to get bigger. So how do you control that spend? It's by looking at alternate funding mechanisms, and that's what we're going to talk about, self-insurance. And there are many different varieties and flavors of self-insurance, and we're going to talk about self-insurance with a captive program. But you have to, if you decide to move in that direction, you'll have an expertise like Karen Quinn and Laura looking at your current data, results of the risk assessment, and then ongoing claims data that we will receive from both the PBM and the TPA to provide recommendations back to you to control your spend, both on medical and pharmacy. So it's just not a strategy where you cross your fingers and you hope that your claims perform better. You really need to implement some strategies, and we're here to help. And I just wanted to kind of lead that in because it's important as we look at the next several slides. Now you can go ahead and advance.
Are you seeing that,
Did
Tom?
I freeze? Or did the slides freeze? There we go. So, yep, I can see that. So we're talking about what is a group captive. So again, we have representation of a dozen or so plus employers on this call, with sizes anywhere from probably 50 employees, maybe up to a couple hundred. So it's taking a similar size employee population and putting them into what we call a shared risk pool, and that's a captive program. And we aggregate all those employers and lives. So now you have large group purchasing clout, and you have opportunity to spread the risk. And instead of getting a 20%, 40%, 6% in that increases that fluctuate, it offers an opportunity to leverage that out and lower it. More importantly, it's claims data transparency that you're going to see on a regular basis, and we're going to take action on that. So improved risk management, we've talked quite a bit about that. That's both on the medical and pharmacy. You have the ability, if you perform well, to share in the profits or favorable claims results. And this is a long-term strategy. You don't decide to move into a captive program and you say, after 12 months, well, that didn't work. Let's move back to fully insured. This is a long-term strategy, and over 5-10-year periods, you will have years where you're going to have large claims. You'll have utilization that will spike, but over a longer period of term, this will be more financially favorable than being fully insured. So questions to ask yourself if you should consider a group captive. And Peter, if you can just go ahead and advance on these through. So whether we have everybody that's a decision maker or we have boards that have to discuss this, but is the leadership of the school district committed to making a change and open to ideas? And if the answer is yes, then let's continue to have conversation and dialogue. Are you frustrated with, again, no data transparency, no ability to control the cost? And again, one of your top expenses, you're just a status quo, and maybe you're getting a good renewal, maybe you're getting a less bad renewal, but staying fully insured is not a long-term strategy. Do you value your employees? And I think the answer is probably yes. And you want to retain and you want to get the top talent. Of course, those answers are yes and yes. So these are probably easy questions, right? Are you looking for a long-term employee benefits strategy? Hopefully you are. Does the negative, oh, that question disappeared real quick.
I'll tell you what it was, John.
Okay.
So the question was, just to clarify, does it have a negative impact on our district to have a 48-hour risk assessment completed? The answer is no. That's information for you and for Dimond Brothers. It's not like when you're checking your credit score that it might sort of ding you, right? This is your information that we're pulling together for you.
And I would add to that, again, as Peter indicated on the earlier slide, so we have underwriters on staff. So what does that mean? It means that we have delegated underwriting authority on behalf of Nationwide, which is our partner. And so our underwriters look at a combination of the results of the risk assessment and also claims experience to determine your pricing. So it's, again, as Peter says, it's not you don't get done like a credit rating, good example, but it's that information we use in your rating. So some of the features of our captive program, and again, these are getting into the weeds, but they're important for you to know. So I'll hit a couple of these really quick. So we do have what we call a no new laser and a 30% rate cap at renewal. So what does that mean? So there will be large claims, and that's just that is just predictable that there will be a large claims. Could be cancer, could be premature babies. There will be something that will be a large claim. So by entering into this program, you will purchase protection in the form of what they call specific pooling points. And there's a rate cap on that particular component of the insurance. And then as you enter into these captive programs, we don't have the ability to what they call laser. And again, it's an insurance industry term, but these are good provisions that we put into our captive program. As a participant in the captive program, you have to put up collateral in case claims exceed in the risk pool. But what we've done is we build the collateral monthly and accumulate it and collect it over 2 years. Most of the captive programs collect collateral up front. And then we have again, a very friendly program that has a nice collateral exit and release and profit sharing back to the participants based off of annual distributions based off the pro rata form. So again, just some features. So if you have looked at captive programs in the past, we have some very favorable terms and features. Again, really detailed, but each one of the employer groups within the captive program will have protection on large catastrophic claims. In this example, it's $25,000. And so you'll pay up to, and again, this is just illustrative, but it could be 25, could be 50, could be 75 based off the size of your group. So you would have protection on individual claims. And then there's a risk sharing and a risk pool on the second layer. So, and then everything above that, the carrier takes risk on it. Again, just probably more detail than you want, but just let you know that we've put in all the right components for protection, both individual and total claims based off of the group. Again, I've used the term favorable financial terms. We talked about the no new laser 30% rate cap. cash flow friendly for monthly collateral payments, and then premium remain back to the captive label based off of the participant's share. So very flexible. And the reason we can do this is our partner on this program, and this is really important as far as the partnership and the paper, the insurance paper that it's on. And so we partner with Nationwide Insurance out of Columbus, Ohio. They're celebrating their 100th anniversary in business, very strong financial term. So that's the insurance paper that's on, and that's how we underwrite it. And our captive is very large, both number of cases, lives, and premium. So a very stable program that we have underwritten the captive programs and partnered with Nationwide. So again, much more detail probably on the captive. The best thing to do is if you, again, as Mark and Rhett continue to have conversation with you, if there's interest, we'll provide a specific proposal for you all and then get into the more details, and welcome to do that. But again, you know, the key here is as we've talked about, if you're on that fully insured, looking to better control your claim spend and your total healthcare cost, it's doing these type of things both on the medical and the pharmacy side that are different than your current fully insured carrier is. And that's where we, you know, PBM, Pharmacy Benefit Manager, we like to use that a lot of acronyms. Laura talked about rebates. So rebates, again, another strange term in our industry, but right now rebates are just going back to the fully insured carrier. So you have the ability, if you select the right pharmacy benefit manager, implement some of the strategies that Laura talked about, better controlling the claim spend, better controlling cost and quality, and then benefiting from the rebates back to the employer group versus back to the carrier. So again, probably a lot of details, but we're happy to continue to answer questions. If there are more questions that you want to put into the chat, happy to do that.
Yeah, John, one last thing, and I'm sure hopefully we get some questions, and I know that that Rhett and Mark probably want to say a few things, but my takeaway from some of what you just covered is very simple: strategy and control, which is just frankly not something that you're able to have a lot of in the fully insured market. Not to say that that isn't terrific coverage, but if you're looking to take the next step, those two things, strategy and control, are the key.
Yeah, thanks, John and Peter. Appreciate your time today. Laura, I definitely want to highlight you as our keynote speaker in all the areas where I really feel like there's a great impact with your partnership through Ryan Specialty. Definitely want to encourage anybody to have any questions you might want to put out there. We'll certainly address those. I know sometimes it's hard to get that started, so I might just share just kind of a quick question here that we get asked a lot is how can we balance premium costs without shifting the financial burden to teachers or risk staff turnover? Again, highlighting, Laura, you know, the PBM, international sourcing, manufacturer assistance programs, co-pay plans. There's technology out there that exists to use your own DNA to determine if your current medications are best suited to treat your medical condition or possibly the correct dosage. I think that's an exciting technology that most people aren't even aware of. We live in a society with healthcare where doctors prescribe meds and they guess and they check. You know, reality is there may be one medication that fits you best. Using these types of strategies will certainly help you get there faster and control that overall RX spend. You know, one quick example I would use for our own group within Dimond Brothers, you know, we had an individual that was on a very high cost medication around $800,000, and we were able to source that down to about $100,000. So again, in that BUCA world, you're just not going to see that type of ability, because what most people don't understand is now the BUCA is now all bought and they own their own pharmaceutical company, their own PBM. Using those PBMs is where they make a lot of their money. So instead of working with the client to help source the least expensive medication. I think that concern has really kind of gone away nowadays because that is a large area where they're generating majority of the revenue. So again, just kind of wrapping up my portion. Appreciate everybody that was able to attend today. It was great to have this conversation, and open up to any other comments from Mark and any additional questions, and we can wrap up the webinar for today.
Oh, by the way, Rhett, that's called pharmacogenomics.
Yes, it is. Thank you for adding that term in there. And like John said, you're the one that pronounced it correctly, so I'm glad that you jumped in there.
Yeah, I'd just like to add that, for those that are currently on a fully insured model, I have discussions with clients how you have good years and bad years, and that was mentioned in today's program as well. The problem is when you're fully insured, when you do have those good years, which the industry says is typically 7 out of 10 years, you're not going to benefit by having a good year. You've paid your agreed upon monthly premiums for your 12-month contract year. And if you have a great year, well, then your BUCA carrier is the one who's enjoying the benefits of your good year. So with the captive program, in addition to getting additional premiums back that the captive produces, you've got the flexibility of adding the MAPR Health program, which we're able to help you determine which prescription drugs you should be on based on DNA swabs that are voluntary but identified by us through the transparency of seeing exactly who is on what particular prescription drugs and who's undergoing treatment for different medical conditions. So there's just so much more that we're able to do in a self-funded program such as a captive. And so hopefully we brought some of those things to light today, and we're happy to have further discussions really at any time. Just reach out.